During the pandemic, people are flocking to learn about investing to get some sort of additional income. Since then, various other forms of investing instruments have boomed, such as crypto and NFTs. But those are risky investments and aren't very friendly with beginners and people with limited capital. So let's get a refresher and learn again about the conventional investment instruments such as stocks, gold, and Forex.
Forex, which stands for foreign exchange, is an action of exchanging currencies of different countries. To put it simply, a value of currency fluctuates with supply and demand and a country's economic situation. We can buy or exchange our country's currency with the desired and promising foreign currency when stable, and then wait for its value to increase. For example, I can exchange 100 million rupiah for around 7,000 US dollars. When the value of the US dollar's currency to rupiah grows stronger, for let's say 5%, I can exchange back to my 7,000 US dollars, which has now become 105 million rupiah. So, there is a margin of 5 million rupiah now in my pocket. Forex is essentially investing a country's economy. We can invest in foreign currency on our own by approaching banks, currency exchange service, or a broker. The principle of stock exchange is similar to any others. We buy when the value of stocks are low and sell when the values are high. Besides exchanging currencies, there is also exchange in company stocks. A stock, always known as equity, is a proof of ownership from fragments of a company, whether it is 1%, 10%, or higher like 80%. The stock value fluctuates based on company's performance. For example, let's say we buy 100 Tesla stocks when the price is 1,000 US dollars. So we pay 100,000 US dollar for it. Sometimes later, the company announced a new line of car models and released a satisfactory quarterly report. Investor will see this as good performance. Demand for stocks and values increase up to 10% from 1,000 to 1,100 US dollars. When we sell our previous 100 stocks, we will receive 110,000 US dollars, a 10,000 profit margin. There are many other forms of stock exchange, but this is of the basics. Investing in stocks are used to be handled by brokers, but now there are many services and applications that is less difficult for beginners. Compared to currency and stock exchange, gold is an older investment instrument and the most popular among other precious metal categories. Investors generally buy gold as a way of diversifying risks, and its value increases on par with the inflation rate. Inflation decreases the value of our money if it's not invested. $1,000 from 10 years ago will not be the same amount as of today, but $1,000 in gold from 10 years ago to today still has the same buying power. So, by buying gold, we reserve our wealth over time. Therefore, we can invest in gold by buying gold stocks or acquiring physical ones from the nearest gold dealers.
So those are ways of investing that we can do to preserve our wealth and make it compounding over the years. But which one should we choose? Especially, you have to consider your risk profile tolerance. Gold and Forex tend to have lower to moderate risk profile, meaning that the price won't rise too much, but also it won't drop too much. Meanwhile, the stock tends to be preferred by higher risk profile investors. They use fundamental and technical analysis to pick the best stocks. But at the end of the day, no one knows for 100% the future of the market. And which one should you choose? Alharkan Erwin Widiastama for See Today.